Hello, my name is David Miller. I'm the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. It's early April. Spring is in the air, at least in the US and the UK. So March was a good month for financial markets and both portfolios made good progress. Dynamic was up by 3% plus, Solutions by approaching 2%. I want to take you back a year though, because a year ago was the low point for the market pretty well. And since then, Dynamic has recovered and moved into positive territory by something approaching 35% and Solutions by 18%. It just shows that discipline at times of exceptional stress does pay off. And it's certainly very pleasing to report the progress made in the last year. Long may that continue. So a reminder, asset allocation, Dynamic is the all equity portfolio, 97% invested at the moment, rest in cash. Solutions is more diversified, 56% in equities, 28% in fixed interest and cash, and the balance in alternatives. I'd like to look at each area in detail, but suffice it to say that in March, equities was the only place to be. Fixed interest had its worst month for many, many years, and alternatives were relatively dull. And that, I think, explains the differential in performance between the two portfolios. Having said that, the foundations of both remain the same: quality, liquidity, diversification. It's just the mix of assets that puts Dynamic, the equity portfolio, fully in line with the improvement in equities of the first few months of this year, where Solutions has that balance. That balance that provided much needed safety and security last year is less necessary this year. Of course, we can take action to protect on the downside within fixed interest, and we have done. The average maturity of the investments held is less than it was, and that reduces volatility. And index-linked stocks, those that are there to benefit if inflation rises, also did relatively well compared to conventional fixed interest stocks. These are the details of fund management. Let's get to the equities and what's going on. Why are things going along quite so well? Well, it all comes down to the US. We've got a phenomenal combination of circumstances at the moment. Firstly, there's a vaccination program that is being rolled out very rapidly, and that is a cause for celebration and for confidence to be on a rising trend. On top of that, the Federal Reserve has said that interest rates will remain low for the foreseeable future, for years to come. Then the government, the US government, is doing its level best to pump huge amounts of money into the system through support to the population, particularly those that have failed or found it very difficult to earn a living over the last year, but then a longer term infrastructure project. Both of them can be counted in trillions of dollars, extraordinary amounts of money. So all of those in combination is really driving the biggest economy in the world forward. The rest of us are following on, but in a patchy way. The UK is doing well. Again, the vaccination program is what is driving confidence and is leading to stronger sterling, the UK equity market recovering well, and more generally a positive tone about the summer months to come. Europe, much less satisfactory. If to put it in perspective, last month the US created 1 million new jobs. Well, not quite that, but near enough. And Germany, none. These are the differences between a successful vaccine rollout and something less satisfactory. This is again the detail, and the detail always matters. If we look at the individual equities, and we are active investment managers picking stocks, it's hard to tell which sector or which country is the best place to be. But that, I think, doesn't really matter. I make the point just to emphasize that there is no one guaranteed answer to making a good return. So last month, 3 best performers: Kion, which is a German company involved in warehouse automation, followed by Barclays Bank, and finally Facebook. Find a theme between those 3, I think you'll struggle. but it shows that there are areas or ways of making a good return on investment for investors in a whole range of areas. And that, I think, is the exciting part and the exciting phase that we're now in as the global economy reopens. So that's where we are. What about the future? Is this going to continue? There's always talk about bubbles and overvaluation and the like. I think it's sensible to address the issue of what could go wrong, but I think there is far more that is going right at the moment, which is why investment markets and the two portfolios are doing so well. Undoubtedly, these remain challenging times. There are many issues that we will have to face up to in the coming months. But on balance, I think that there is cause for optimism. And the job of fund management is to look at all the available information and then make judgments and then implement. It's no good being a spectator on the sidelines. And so our judgment is that we will continue to see an improvement in economic growth led by the US. We will continue to have low interest rates and relatively low inflation for the foreseeable future, and that is a really good foundation for good companies to make good returns, and by association, shareholders will benefit. So that's the state of play at the moment. That's why we position the portfolios as we have, and that's why they're delivering the returns that we are seeing at the moment. I hope these comments are of use, and I look forward to reporting to you again in a month's time. Thank you.